This is CGTN, China Global Television Network.
Hello there, welcome to this edition of Global Business Africa. In the course of the hour, we'll run through the business news ideas and stories you need to know about from the continent and beyond. But first, a quick run to the markets for you. Starting in Nigeria, essentially all the gains that we saw in late January and early Feb, that essentially has been wiped out. On a year-to-date basis, the oil share over there is up by barely 0.5%. But some shares are doing particularly well. Seplat Petroleum, for example, is riding that trend that we're seeing on the commodities market. Its shares are up 36% as oil prices have continued to rise so far in the year. The outstanding performer on the continent so far is the oil share in South Africa. The JSE up 13%, and it just keeps setting multi-year after multi-year high. Those are your markets. Here's what's coming up tonight. Zimbabwe's confident it can keep inflation in check despite increases in monthly rates. Tanzania's gold earnings have risen off the back of higher output and higher prices. And we'll explore how Egypt wants to introduce low-cost electric cars to replace thousands of unlicensed, heavily polluting rickshaws. Our starting point tonight, however, is right here in Kenya. The government here has reached a staff-level agreement in the last 24 hours with the International Monetary Fund for a $2.4 billion loan. Now, the fund will be spent on the second phase of Kenya's COVID-19 response. Kenya sought the loan from the Washington-based lender back in December, and that followed a $739 million credit facility that the country secured also from the IMF in the month of May. The pandemic has battered the East African economy. It's affected tax revenue, income tax and VAT collections, for instance, are down 15% as movement restrictions weighed heavily on activity. For 2021, the IMF is expecting Kenya's economy to grow by around 7% after a slight contraction of 0.1% expected in 2020. Now, that deal, of course, does have to go to the executive board for approval in another few weeks. But what are the policy implications for the East African tea and coffee producer? Let's find out. Churchill Agutu is the head of research at Genghis Capital. He joins us live on the program tonight. So, Churchill, the statement from the fund focused on fiscal consolidation. We've heard that phrase over and over again over the last 3 to 5 years. But Kenya's finance ministry has been promising fiscal consolidation for years, and it's failed to do so. Do these latest promises of fiscal consolidation have any credibility?
Thanks, Ramah, for having me on the show. Speaking of fiscal consolidation in the current fiscal year and also in the next one, against the context of COVID-19, I think that even the IMF have sort of closed their eyes on that and somehow said that fiscal consolidation may not be achievable in the current financial year and in the next one. But having said that, and looking at the Kenyan authorities, so to speak, we've seen that in previous financial years, even before the budget is passed, you find that there are usually some revisions. Be it through the budget policy statement, you find that the figure is lower than what will be approved with the budget. So you find that it's usually a moving target, that fiscal deficit in any given financial year. So even in the current context, in regards to credibility by the authorities, I don't think that that is also in the cards. You hear the phrase that a leopard does not change its spots, and that could be aptly referring to National Treasury. Right now, in the current financial year, amidst, even against the backdrop of COVID-19, on the budget policy statement, Treasury is quite clear that they are not pursuing an increase in public expenditure. But right now, we are on the cracks of supplementary budget, one estimates, which is skewed towards an increase of $750 million. So to me, it's just telling us that there's still not that credibility by the Treasury officials, at least to see some form of fiscal consolidation to be in place in the country.
Indeed. So the statement from the fund also has some other interesting elements in it. It says that the program, the 38-month program, Kenya is agreeing to under this in exchange for this $2.4 billion loan. It says it will focus on raising tax revenue. But In December, we removed pandemic relief measures. Income tax rates on personal income, corporate income went back up to 30% on the top rate. The 200 basis point cut in VAT, that was removed. We introduced at least two new taxes, a minimum tax and a digital services tax with effect from the 1st of January. We've removed pandemic relief. We've added more new taxes. Is there any more room to raise taxes further?
Yes, we are coming at a point whereby some of the tax reversals that were there in the initial days of COVID-19 were reversed at the front end of this year. So we don't see that there'll be much wiggle room in terms of having some more additional tax revenue streams per se. And just against the backdrop that next year is a campaign year, is an election year, that issue about bringing on board some new tax revenues will become a hot potato issue. Having said that, and if I take you back to last year's when we had the tax laws amendment, the first tax laws amendment act, whereby those that uplifting of some of the tax incentives that were then in the country, I think in my view that was the route that we saw in terms of having some tax revenues being put in place. But having said that, I don't think that there's any more measures that will be put in place in terms of new revenue streams, other than now putting in place some of these controls to reduce slippages in tax and also the tax administration. So that's where the emphasis will be.
Right.
But to be sure, we are saying that in the next financial year, ordinary tax revenue has been jacked up by $2 billion, which is just telling us that it's primarily hinged on our growth recovery, with Treasury now estimating a 7% jump in the growth in the current calendar year.
It's a very optimistic outlook. One last question for you, Churchill. So without any aggressive debt restructuring or reprofiling, to use a term that the authorities prefer to use here, Kenya can't meaningfully reduce its debt service costs, can it? Because we're spending something in the order of $8 to $9 billion every year just on domestic and foreign debt service.
Yes, and in fact, you find that there's a skew that there's been not getting into the commercial financing, which we saw it play out in the last financial year, but there's been a bias toward the domestic front. But having said that, the costs, if you look at it, is in the order of 8% going up, is still elevated on the domestic front. Looking at avenues of restructuring, I think it's the Treasury or Kenya is in a tight spot. But having said that, at least there's been some positive developments, just looking at the budget policy statement, whereby there's an expected refinancing of some of the external debt. In the current financial year, we're seeing something in the order of $2.2 billion. In the next financial year, $3.5 billion. So to us, it could be now those commercial financing, be it Eurobond or the syndicated bonds, and just taking advantage of what's happening in the current global arena, whereby there's that outsized liquidity from the developed market, there's a hunger of yield by some of the investors, and also the yields of even in the Eurobond have somehow reduced, tanked compared to where they were pre-COVID-19. So all these three factors are coalescing to at least make the environment more favorable to a refinancing, but we'll likely see how that will be executed in the next 4 months towards the end of this financial year.
Indeed, a Eurobond, of course, is certainly on the cards. We'll leave it there for the time being. Churchill Ogutu, Head of Research at Genghis Capital. Thank you. Now, from East Africa to Southern Africa, where Zimbabwe's central bank is confident it can stay on top of inflation despite increases in monthly rates in December and January. A raft of measures instituted last year managed to lower the annual inflation rate from a 10-year high of 837% down to just under 350% in December. Here's Farai Makutuya from Harare.
The Reserve Bank of Zimbabwe is forecasting ambitious 1% and 10% monthly and annual inflation rates respectively by the end of this year.
To be honest, it is achievable. However, there are some worrying signs. Let me give you an example. Reserve money, which of course is the total money in circulation in the economy at any one time, averaged about 13 billion Zimbabwe dollars through 2020. But since December, it's risen to over $18 billion, which works out to about a 117% increase in reserve money. And of course, reserve money and the exchange rate have a direct correlation linked to inflation.
A weekly foreign currency auction has stabilized the Zim dollar's exchange rate, but demand for hard currency outstrips supply, perpetuating the parallel market. The Minister of Finance has promised to pump more forex to prop up the auction. He's also claimed that the country has weathered the COVID-19 storm. However, a virulent second wave has forced a hard lockdown, which has been extended to the end of February. That's left most businesses inactive for this period and most likely unable to meet their tax obligations to Treasury, which may affect revenue collection targets and force the government to take the undesired route of borrowing in order to meet its expenses. A pressing one is COVID-19 vaccines, which require at least $100 million to cover 60% of the country's population.
The question is, where will Zimbabwe get that money from? Will it be from domestic finance resources? In that case, does it mean that the central bank may enter the market to raise money for the government, which of course would increase money supply again, because they would be in essence printing money? Is it from foreign borrowings, which again would have to be repaid? That's why I say that there are things to watch out for, and monetary authorities and the Ministry of Finance must keep an extremely tight hand on this. They need tight monetary discipline, they need tight fiscal discipline for them to be able to achieve their targets.
Based on their record in the latter part of 2020, authorities here will be upbeat of their chances. Farai Mwakutuya, CGTN, Harare, Zimbabwe.
A quick run through some company news. Let's start in the world of telecommunications. South Africa's largest mobile operator, Vodacom, managed to weather the 2020 storm. It was a troubled time for many counters on the JSE, and it weathered it better than other local telecommunications firms. For the 3 months ending in December, Vodacom's revenues are up by over 6% to nearly $2 billion. Service revenue is up 4% year on year to $1.3 billion. Vodacom has attributed the growth to ongoing investments in connectivity, financial and digital services. The mid-tier gold producer Pan-African Resources has nearly doubled its interim earnings from a mix of underground and tailings retreatment operations. The miner managed to increase its net cash generated from operations by over 170% to $28 million in the 6 months ending in December 2020. It also managed to reduce debt by over 47%. Earnings per share went up by 85% to $1.14 apiece in the 6 months ending in December, from the 6 months ending in December 2019 to $2.11 in the period under review. The global auditor KPMG South Africa's arm will no longer be offering consultancy work to JSE-listed companies. That decision will apply to all listed firms on its books from the 1st of April. This comes as the global accounting industry is under a fair bit of scrutiny and public pressure to split its services. A number of firms, including Barclays Africa, Sibanye-Stillwater, the national government, have all stopped using services from KPMG. And finally, Deutsche Lufthansa is in talks with plane makers about swapping some orders for larger aircraft for smaller models with longer range. Europe's largest airline group is looking to adapt its fleet to an enduring slump in intercontinental business travel as the pandemic completely decimates demand. Shares in Lufthansa were about 4/10 lower in early trading in Frankfurt. The stock has added about 1.4% this year after losing a third of its value in 2020. That's a run through your company headlines. You're watching Global Business Africa. Time for a short break. Here's what's coming up. Platinum prices are rallying again. They're surging to the highest level in more than 6 years. And after spending billions bailing out airlines, Germany plans to spend another $1 billion bailing out airports.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business. Only on CGTN.
Africa is the nexus of enterprise, and Global Business will tell you why it matters.
From the mega investment projects to multi-billion-dollar mergers and acquisitions.
Africa today collects, just in terms of revenues from taxes alone, $545 billion a year. If you take 10% of that and you devote it to the energy sector, problem solved.
All this on Global Business, weekdays at this time on CGTN.
Welcome back to the program. Now, pressure is mounting on countries pretty much across the world to speed up their climate adaptation, as forecasts indicate more extreme weather events to come this year. In recent weeks, Tropical Storm Eloise made landfall in South Africa. That caused some pretty serious storms, and it's dumped inches of torrential rain across the entire region. Here's Sumitra Naidu with the details.
Mop-up operations are continuing in parts of South Africa where persistent rains continued for weeks. The Northern Cape, which has been struggling with drought in the last 2 years, has now had too much rainfall. The region has been declared a provincial disaster.
Northern Cape was experiencing its worst drought in 100 years, where there was no sources of water in many of the towns. Then come last week, Northern Cape experienced its worst flood since 1974. This is a province that experienced two devastating forms of natural disasters, where we found villages being washed away, bridges, roads completely destroyed.
The weather has cleared up for now, and the dams across the country have been filled to capacity. While this is good news, the recent heavy rainfall has caused severe damage in some provinces, and it's not over as yet. The Weather Service is warning that more rainfall can be expected.
The deep cyclone that was busy forming after the cyclone Eloise, that dissipated. It is now changed into a tropical depression that's hanging over Mozambique. We expect severe rain north of Durban, from all the way from Richards Bay up to Josini. And those people must know that if these models are only 6 hours away, the chances are that it will be a severe rainfall of 80 millimeters per hour for about 3 hours. That gives you over 240 millimeters of rain, over 200 square kilometers.
In Johannesburg, emergency services have been hard at work providing relief and assistance to flood-hit communities.
We've always warned people about the fact that there are floodplains. In Chaskei, we've moved people away from the water. And in many areas where informal settlements are mushrooming, we always warn them against the dangers of building closer to the Thames. But otherwise, we also have been going on an education program through Estlina Joburg to warn people from throwing things into the stormwater drainage.
Weather experts and scientists are warning of more weather phenomena as climate change intensifies. La Nina will bring relief for drought-hit areas in southern Africa, but comes with its own devastation. Environmental activists are calling for swifter action in dealing with global warming, as these adverse weather patterns are increasing poverty, especially across Africa. Sumitra Naidu, CGTN, Johannesburg, South Africa.
Let's make a detour into commodities, specifically platinum. Platinum has rallied yet again. It surged to the highest level in more than 6 years on signs that an economic recovery from the pandemic is set to boost demand for the metal that's more often are not used in making catalytic converters. The precious metals price has gone up by over 20% so far this year. It's actually outperformed many of its peers, aided by tight supply caused by the outage of a key refiner last year. Demand for platinum from car makers is also expected to rise in 2021, driven by surge in car sales and much higher loadings in Chinese heavy-duty vehicles as well. Increasingly, the metal is also being viewed as a greener economic, on a green economic recovery from the pandemic. Europe, China, the US, they're all tightening emission standards this year, and that in turn has boosted demand for platinum group metals. All right then, so platinum is having a fantastic year, but what's the outlook for this particular asset class in 2021? Let's explore that in some detail. Peter Major joins us now, of course, for a discussion on this. Peter, good to have you on the program yet again. It seems you always tend to speak in the first quarter of the year. But Walk us through what's happening with platinum, up 22% in the spot market, but palladium prices in the spot market relatively flat over the same period. What's happening with those two?
Well, Ramah, good questions as usual. They call them the PGMs, the platinum group metals. And when you mine platinum, you almost always get the other 5 metals with you. But in some of the countries, you don't get the spread like you do in South Africa. In South Africa, you get a lot of palladium with your platinum, and you get a fair amount of rhodium, and yes, you get ruthenium and iridium. So if you want to mine PGMs and get a good spread, you come to South Africa. Now, what happened for a century, the platinum price averaged probably double what the palladium price did. And the world could live with that until they started making auto cats in the 1970s. And by the 80s, people were finding out, hey, palladium does almost as good a job as platinum, and it's less than half as much. So by the 90s, there was a big push, especially in America, to use palladium, which was half the price of platinum, and there was a surplus. You know, the Russians were dumping tons of it on the market with the fall of the Soviet Union. So everybody was gearing up to use palladium, and the engines now are designed around palladium. So before you know it, now there's a squeeze. There's not enough palladium to go around for everybody. And China's come out of almost nowhere in the last 10, 20 years. It's now producing 20 million vehicles a year. That's more than America ever produced. So they've gone from almost 0 to 20 million in probably 15, 20 years. So yes, palladium went mad. There wasn't enough of it. And we knew it was only a matter of time when there's another commodity that will work almost as good with a little work, and it's selling for half the price. So last year, palladium was touching 2,900 an ounce, 3,000, and platinum was lucky to be 800. The gap was too big, and now you're seeing that gap closing fast. Platinum is now down to half the cost of palladium, whereas it was only a quarter of the cost a year ago. And I think the gap will continue to close, and platinum is very good in fuel cells that palladium is not. And we're seeing a big push for fuel cells with green energy.
Indeed, we'll get to that in a moment. But let's look at the production side for the time being, because between the pandemic, limiting how many workers you can have in a mine, limiting mine operations, plus, of course, the power supply issues that have plagued South Africa for years now, it looks like output might be flat this year. But what's the outlook collectively between South Africa, which is about 55% of global output, and Russia, which accounts for about a quarter of PGM output?
Look, you're right on your percentages. It is not easy to increase production. If you come to South Africa and you run a mine here, you'll see how difficult it is just to run a mine at normal production. But to increase production, you have to spend money. And there's a lot of rules and regulations. And until recently, that money you spent was wasted. You know, a company called Lonmin spent billions and it went broke because they had the community against them. They had government regulations against them. They really had the unions against them. And then when the metal price went against them, well, that's 4 out of 4. So companies are reluctant. It takes 5 to 10 years to get all the permits and build a mine and get it running. So it's very hard to get investors to build a new mine. And boy, the mines that survived, they are wise. They've been through tough times, and they're reluctant before they start building more production and lower the price. What for? They're actually quite happy paying out big dividends to long-suffering shareholders and tweaking their production. And that's all they can do. And the same with Russia. Russia's had flat production for decades. Canada, flat production for decades. Maybe not quite. There is North American palladium. It's growing, but it's small. Stillwater platinum in America, it's trying to grow, but it's very expensive. It's got a difficult union too. So this isn't a garden hose. It is hard to increase production more than 5% one year after another.
Indeed. Amplat's management had an interesting presentation last year. I mean, they basically made the case, look, we've been here before. Prices go up. It seems like there's a lot of future demand that will come out of nowhere in the future. As you mentioned, China's a huge market for vehicles at the moment. But is this time different? I know that's a bit of a cliche question, but is this time different?
This is the first time I've seen mining companies ask that question, Ramah. Usually they say, oh, this time's different. It's going to keep going. And they just spend like there's no tomorrow. and it always reverts to the mean. It goes in a sine wave, it goes up, it comes back. This is a very different boom. All the mining companies, just look at Bulletin today. They're paying out 85% of their earnings in a dividend. And this is prudent management, something we hardly ever see from mining companies when there's even a little rise in metal prices. It's very prudent management. I think they're really thinking of their shareholders. And yes, they have been here before. And now they're acting like they've seen this movie before. Now they're acting like they have been through this situation before. And they're proceeding cautiously and wisely. And, you know, if these prices stay up another 6 months, they'll increase some more production here. If the prices are like this at the end of the year, they will bring on more production. But everybody has seen this movie and they want to know, is this sustainable? Because these are insane prices.
Indeed. You mentioned hydrogen fuel cell tech, which is an interesting new growth area, for lack of a better word, as far as platinum use is concerned. Walk us through the market potential there.
Wow, we've heard about the market potential of this for 30 years. I remember being an analyst in 89, 90 and being told these fuel cells in cars and generators, they are around the corner, Peter. This is 2, 3, 4 years down the road. This is in 1989, 90, 91. It's taken a lot longer for them to become as widely used as they are now. And they're still barely scratching the market. But it can escalate fast. And I think the platinum price is showing that it's not just going up because people are putting it back in autocats. People are building fuel cells. There's a big push now for green energy. There's penalties for producing dirty energy. And the public wants clean energy. Fund managers, pension funds want it. So the potential is huge. You know, we were using platinum fuel cells in space in the 60s because it's small, it works, it's reliable. It was kind of expensive before. And the more you build something, the easier it is to build, the cheaper it is to build and to use. So the potential on these fuel cells is gigantic.
One last question for you, Peter. Going back to the question around valuations, it looks like investors have fallen in love once again with the platinum majors in South Africa. Amplat, at least from the second half of 2019 to date, up 200%. Implat, 500%. But given all the things that you've mentioned and all the downside risks that we're looking at in the future, hydrogen fuel cell tech might not necessarily take off. At the same time, South Africa may have its own issues. Production, carbon taxes are still a big problem. Are these valuations justified?
Yes, they are. You're talking about share price moves. That's not a valuation. The platinum index has gone up fourfold in about a year and a half, 4 times. So your immediate reaction is, wow, that's too much. Something's gone up 500%, 400%. It's too much. But valuation is its price earnings relative. Valuation is its earnings yield. Its price earnings relative is actually below its long-term mean. It's about 25 to 30% below its mean, its long-term mean. So that means investors are very wary. These shares are currently trading at a discount to their long-term valuations. And it's because at these crazy prices, even nutcases are saying, I'm a little afraid that these PGM prices are too high. So they're already starting to sell the shares at a lower valuation than they should be, because the whole world is afraid and is discounting. They're going to start coming back. And if they don't, then they're cheap. But yeah, based on today's metal prices, the valuations are not high. They're actually lower than the average.
Indeed. So at least we should probably stick a sign of, only the brave can venture here. Peter Major, always funny having you on the program tonight. Thank you very much. Now, speaking of commodities, let's head over to Tanzania, another large exporter of gold on the continent. Its earnings from that precious metal were up by over a third last year, helped by increased output and higher prices. Spot gold prices rose by 25% last year. They went as high as $2,060 an ounce in July. Gold exports fetched Tanzania $2.95 billion in revenue, about a third more than the figure for 2019. The country's central bank is forecasting that economic growth may exceed 6% this year, driven in part by public infrastructure spending. From Dar es Salaam, here's Daniel Kijo.
Tanzania's gold mining industry has made history. Tanzania's central bank reports that over the last year, gold earnings have risen by 34%. That's the highest amount ever earned since 1894, when the country's first mine started operating under German colonization. Jared Mturi from Tanzania's Chamber of Mines says that mining reforms made in 2017 and the introduction of regional gold markets was a game changer. The amended Mining Act, which among other provisions, raised the royalty rate from 4 to 6% with respect to mineral exports such as gold, copper, silver and platinum. Also made it mandatory for all mining licenses or special mining license holders to give the government at least 16% free carried interest in the capital of their companies. He says before the reforms, small-scale mining's contribution was 5% annually, but now it went up more than 4 times.
They contributed 29% of the total gold production, which is a record, and it's quite amazing.
According to the Tanzanian Investment Center, the global effects of the COVID-19 pandemic caused a decline in investment, causing investors to buy gold, which is considered a safer bet. This caused a rise in the price of gold, something which helped Tanzania's other sectors that were suffering the effects of the pandemic.
The increase in revenue in gold sales has stabilized or compensated the lost revenue in tourism.
The 2017 mining changes were meant to increase revenue and make sure profits from the country's natural resources benefited Tanzanians. Some analysts say that the mining changes enacted over the last 4 years have been largely positive, as they have made the country's mining business less stringent and more organized. This has helped small-scale miners and foreign mining investors to operate with more transparency and clarity. Economist Gabriel Mwangonda says that is a good start, but more needs to be done.
Tax or impose fees on those special mining sectors should be structured in a very different ways, not like the way you tax gold should be used in the very same way when you mine tin, let's say, or copper, or we have all those sort of minerals. So we need very specific laws to very specific minerals.
The extractive industry remained one of Tanzania's key economic sectors, with a huge potential to lift Tanzania's economic status. It is hoped that with further improvement to laws and regulations, the mining sector will increase much needed foreign direct investment. Daniel Kijo, CGTN, Dar es Salaam.
A slight diversion now into the business of global trade. China has congratulated Nigeria's Ngozi Okonjo-Iweala after she was appointed as the new Director General of the World Trade Organization on Monday. In applauding the appointment, China's representative and ambassador to the WTO noted that Iweala's appointment shows the broad support that member states have for her and their belief in the multilateral trade framework. China's Commerce Ministry also extended its congratulations to the 66-year-old Harvard and MIT trained economist. The ministry said it hopes the WTO, under her leadership, will resume its normal functions as soon as possible and play a greater role in the global response to COVID-19 and the economic recovery that the world needs.
近年来，贸易保护主义、单边主义在全球蔓延。
Protectionism and unilateralism are spreading globally. People hope that the WTO can do something, especially amid the pandemic. Many members and the international community are very excited about the new appointment. It shows people's support for the new chief and their belief and confidence in multilateral trade.
Diversion into the world of cryptocurrencies now. Bitcoin continues its blistering rally. It surged earlier today to an all-time high, over $50,500. The world's oldest and largest digital currency by market value rose by over 3% earlier today to hit that level before falling back a bit later under the $50,000 mark. Now, in dollar terms, Bitcoin's value has gone up by 70% so far this year. Bitcoin has gotten a boost from news of large companies like Tesla and MasterCard showing support for crypto. Just last week, Tesla not only revealed it had built up a $1.5 billion position on Bitcoin, it also said it would accept it as payment for its products. MasterCard, on the other hand, announced plans to open up its network to some cryptocurrencies. PayPal and the Bank of New York Mellon have also made moves to support crypto. Now, the value of announced mergers and acquisitions with any sub-Saharan African involvement reached nearly $26 billion last year. That's according to a report by Refinitiv. The analysis shows that total deal value last year, though, was 62% lower than the figure recorded in 2019. The value of deals recorded in 2020 were down 5% to a 7-year low. The value of deals with a sub-Saharan African target also fell by nearly 40% to a 16-year low of $12.5 billion, even as domestic M&A within the region fell by 44%. The combined value of inbound deals reached just $7.1 billion. That is the lowest annual total since 2009. Let's explore that data set in a bit more detail. Lucille Jones is a deals intelligence analyst at Refinitiv. She joins us live on the program tonight. Lucille, good to have you on the program. So if we strip out one of the big deals in 2019, Naspers is spinning out of its tech assets, putting Process on the market in Amsterdam. How does the 2020 deal volume compare to 2019?
Yeah, sure. Yes, so that one deal, Naspers mammoth $36 billion internet assets spin-off, it accounted for just over half of 2019's annual deal-making total. So it really boosted deal-making in that year and sort of exaggerated the decline in activity last year. But even without this huge deal, we are looking at a 30% decline in deal value from 2019. And compared to sort of 2018, 2017, we're down around 20%. 2020 actually recorded the lowest level of annual deal making in the region since 2012. So we're still looking at an 8-year low. But actually, if we start to look at the quarterly or even monthly totals, it can give us a better understanding of how the year ended and where we are now. So the year started pretty well with deal making in January and February at reasonable levels. And then, like the rest of the world, the COVID-19 pandemic put the brakes on deal making from around March time. The lockdown regulations had this, extensive impact on economies around the world, and Africa was no different. We all know that M&A activity is driven by confidence in the target business and in the economic and the political environment. So deal making just it paused. Companies took a wait and see approach, and it led to sort of less than 50 deals being announced in the region during both April and May. But then what we saw over the summer and through the rest of the year was a lot more positive. M&A gained momentum, so we had between 60 and 70 deals announced during each month from June through to the end of the year. And to put that into perspective, the average number of deals announced each month over the last 5 years is 68. So we're back to a very normal level in terms of the number of deals being announced in the region. And actually, in the last 3 months of the year, we saw an uptick in deal value from the respective months in 2019. Just the uptick wasn't enough to compensate for the sort of the spring freeze.
Indeed. So 2020, though, also was interesting on the monetary policy front because you had central banks pretty much around the world, Japan, the ECB, the Fed, they all were busy cutting rates, making money as cheap as possible to give some room to deal with the pandemic. With rates as low as they are, arguably, why wasn't there more deal flow? I mean, was it a lack of effective demand, or are investors looking at the continent and asking themselves where the investment-worthy companies across the continent?
I think last year, certainly during the first half, the focus of executives was, it was directed more to saving their own companies instead of to, buying others. There were just so many challenges. Valuation was very, very difficult when businesses had come to a complete halt and nobody knew when they would start making money again. In addition to the economic uncertainty and the valuation challenges, there were also physical challenges, so physical constraints, travel restrictions during lockdowns. They all, they proved a challenge for deal making. Meetings and negotiations, they couldn't be made face to face. Site visits, due diligence, all were made more difficult. Deal makers had to adapt, and adapt they did. They used technology to address these logistical challenges. Zoom meetings, video conferencing, data rooms, the use of drones for site visits, etc. So they adapted, but it was a very challenging year for deal making, and it was the same globally. Globally M&A declined, and Africa was no different. But we did see it, gain momentum towards the end of the year. I don't think it was due to a lack of investment-worthy firms. We saw, the good investment opportunity across the continent, a lot of growth potential on the continent, and also, harder hit sectors. The pandemic could also create some more opportunity to acquire sort of quality assets at a discount. So we might even see a bit of an uptick this year as well.
Indeed. So looking at where the deals were located, manufacturing at the top, energy comes second, tech was third. But now that it seems we've sort of figured out a pattern that sort of works within this pandemic, might tech vault to the top of that list? Might that order change in 2021?
Yeah, possibly. I think the COVID-19 pandemic, it certainly brought industries into a sharper focus, certain industries into sharper focus. So either because they were pretty much shut down early in the pandemic, or because the demand for products and services in those sectors soared. And tech is definitely one of those sectors. So, it was able to take advantage of the conditions that we saw last year. We all saw how important technology was and still is during lockdowns, both in personal lives and at work. So technology, along with healthcare, have great growth potential, fintech as well, and I think those sectors will attract investment. Tech may have trailed behind energy and materials last year, but we did see investment. We saw that it was the third most active sector. It accounted for a fifth of deals by value. We saw private equity investing in South African internet provider Octotel. We saw investments in programming firm Kathia Communications, in a manufacturer of fibre optic cables. In fintech, we saw Stripe expanding into Africa for the first time with the acquisition of a Nigerian payments firm. We also saw a British company acquire direct payments online. So again, all these fintech opportunities here that we saw last year. And we've started to see investment already this year with a huge group launching an offer for South African software firm Adapt IT. So yeah, definitely a sector to watch.
I'm going to wrap up relatively quickly because we are running out of time for this. But looking at the value of deals within the continent, we had this overall number, $25.7 billion worth of M&A. But what percentage of that was happening within the continent? Because a lot of the headline deals that we saw, like Stripe's acquisition of Paystack, for instance, that was foreign capital coming from outside the continent, acquiring an African company. But what about deals within the continent? What percentage of that was made up of that 25.7 billion, and what's the outlook for 2021?
Sure. So domestic M&A, so which is a domestic deals within one country, and sort of intra-African M&A, so between, so for example, South Africa and Kenya, they accounted for just over 20% of deal making last year in the continent. And that's the highest share in 3 years, so it's actually increased in share. We still saw a decline in domestic M&A from last year, but it's slightly up on 2018. So I think there's the outlook is good for domestic deals in the region in 2021.
All right, we'll leave it there for the time being. Lucille Jones from Refinitiv, thank you very much. Time for a short break. You're watching Global Business Africa. Here's what's coming up. Germany plans a $1.1 billion bailout to aid its pandemic-hit airports.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant. Only on CGTN.
I try to not let it affect me, but there are days when it does. I'm a human being, and to see patients in a hospital bed and their family members are not there, there's no one there to hold their hand, that human touch, you know?
I
I just hope everyone can remember that the situation is not permanent and that everything will get better eventually.
Welcome back. Let's recap some of the stories making your headlines at the hour. 5 people have now died from Ebola in Guinea as the government over there has launched an urgent contact tracing operation after the latest reappearance of the hemorrhagic fever. Guinea announced the outbreak on Saturday. This is the first in West Africa since a 2013 to 2016 epidemic that left more than 11,300 people dead in Guinea, Liberia, and in Sierra Leone as well. Over in the Democratic Republic of Congo, the World Health Organization and humanitarian agencies are rushing to stop the spread of the deadly Ebola disease after 3 cases confirmed in a week. These cases were reported in Butembo, which was the epicenter of the previous outbreak. That was the DRC's 10th Ebola outbreak. It was formally declared over just last June. According to the French President Emmanuel Macron, France has no immediate plans to adjust its military presence in the Sahel, and any changes will depend on other countries' troop contributions. Mr. Macron urged the G5 Sahelian nations, Burkina Faso, Chad, Mali, Mauritania and Niger, to expand their own anti-terror fight and to work on restoring government control and public services in areas where jihadist fighters have been operating. And finally, 2 men accused of leading Christian-dominated militias in widespread attacks on Muslims in the Central African Republic have denied all charges against them at the start of the trial at the International Criminal Court. Patrice Edouard Ngaisona and Alfred Yakatom both pleaded not guilty. That's a run through your headlines. Away from the continent now, a court in the Netherlands has ordered the government to end nighttime curfews, saying they have no legal basis. The court order essentially deals a blow to the government's response to the COVID-19 crisis. The government insists that the curfews are needed to prevent a surge in infections from more contagious new mutations of the virus. The number of cases in the Netherlands has fallen to around 3,000 to 4,000 cases a day, and that's down from a peak of 13,000 back in December. The country has 1 million active cases and some 15,000 deaths among its population of 17 million. Now, quick plates of news on the vaccination front. Starting in South Korea, the country secured additional COVID-19 vaccines for 23 million people. That raises the total number of secured doses to a level sufficient to cover nearly 80 million people. Keep that number in mind. The country will receive doses for 20 million people from the US pharmaceutical Novavax and additional doses for another 3 million people from Pfizer. South Korea is preparing for an inoculation drive set to start on the 26th of February. The country has already secured agreements for enough doses for 56 million people. That's 7% more than its population of 52 million people. The vaccination program will likely get off to a slow start, though, as some of the vaccines acquired have not yet been proven to be sufficiently effective against new strains of COVID. Australia and New Zealand have also received their first COVID-19 vaccine deliveries as well. Inoculations with the Pfizer-BioNTech developed jabs are set to start in the week to come. Both countries impose snap lockdowns in areas that have seen new surges. New Zealand officials say border workers will be among the first to get the shots starting this weekend on Saturday after safety checks. Prime Minister Jacinda Ardern says that the country plans to offer free vaccination to all her citizens. Japan will start its COVID vaccination program on Wednesday, the 17th of February, with 40,000 medical workers first in line. The government says it aims to complete the vaccination campaign for the targeted population within a year. Vaccinations for the elderly will start in April. All other parties are expected to be eligible to be vaccinated from June. Japan officially approved the COVID-19 vaccine developed by the Pfizer and Moderna on Sunday. Japan, remember, is home to over 126 million people. Nearly 30% of them are over the age of 65. Authorities there have so far inked to purchase agreements for 314 million doses of vaccines from Pfizer, AstraZeneca and Moderna. Those are collectively enough to cover some 157 million people. Over in Europe, away from vaccination, Germany is planning a $1.1 billion bailout for the country's airports as months of lockdown have sent their revenues plunging. Now, that's on top of the billions of dollars that Berlin has already spent to help the aviation sector survive the economic damage caused by the pandemic. Ryan Thompson reports from Frankfurt.
Berlin's former airport has found a new calling in the coronavirus pandemic. It's nothing to do with aviation, but it could be a lifeline to help Germany get more planes in the sky by the summer. Air travel is at a historic low nationwide. Hubs like Frankfurt have slashed flights, welcoming just under 19 million passengers in 2020, a far cry from the 70 million the year before.
Fewer passengers means less revenue. To be precise, about $3.6 billion less for Germany's airports, who say they're on the verge of collapse. Berlin has heated warning signals, and on top of billions in aid already shelled out for struggling airlines, is now giving a bailout to the country's airports.
But the deal is far from simple. Competition rules and private ownership mean that every airport will see a different aid package. But the real pinch is being felt at smaller regional airports, which have faced the most drastic schedule changes. They are a lifeline to keeping Germany's most remote corners connected.
You don't have a good infrastructure for trains, and you don't have a good infrastructure for cars and cargo. The airport is the main important infrastructure for traffic.
Germany is obviously still in lockdown, and you're operating very few flights. Will you get the aid that you need?
We kept the airport open. We had a lot of costs, of course, but I think we will get some kind of reimbursement.
Though most planes are grounded now, small airports like this are also betting big on a return to tourism once the lockdown is lifted. But further border restrictions aimed at preventing new strains seem likely and could still hamper the recovery. Ryan Thompson, CGTN, Frankfurt.
Quick update on commodity prices. Brent crude still holding above $63 a barrel. It's going to be interesting to see how the cold weather that we're seeing in the United States at the moment is going to affect oil processing, refining, and of course deliveries to key hubs in and around that particular country. Platinum prices as well. Interesting development on that front, under $1,300 an ounce. In fact, they've actually pared back some of the gains, but even at those levels, around $1,269 an ounce at the moment, you're still looking at an 18% rise so far this year. Here's what's coming up next. Egypt is set to introduce low-cost electric cars to replace thousands of unlicensed and often heavily polluting rickshaws.
You don't find the stories of North Africa by sitting on the sidelines. No one else will take you where we can in North Africa. And no one else will show you what it's all about. CGTN, see the difference.
Welcome back to the program. Let's head up north over to Egypt for an interesting transportation story. The country essentially aims to introduce a fleet of electric cars in a move to gradually replace thousands of unlicensed, often heavily polluting rickshaws which roam the cities. At least 45% of the components that will make up these electric vehicles will have to be made or assembled locally. The finished items will go on sale at relatively low costs to encourage the speedy replacement of the older polluting rickshaws. From Cairo, here's Yasser Hakim on Grassroots.
The auto rickshaw, known as the tuk-tuk in Egypt, is a common mode of transport. There are more than 500,000 that have been licensed to operate, but experts say there are more than 1.5 million roaming the country's streets. Although they're suitable for most poor and overpopulated neighborhoods, there have been plans by the government to ban the tricycled vehicles.
They started to spread in Egypt in 2009 and anyone could operate them. The problem of tuk-tuks is that most are not licensed. A lot of social issues have increased with the presence of tuk-tuks, including kidnappings, theft, underage drivers and traffic jams.
The government is now offering an alternative, which essentially is an electric rickshaw introduced by a partnership of the state-owned entities with the private sector Dulaibat Egypt that will see the commissioning of electric cars.
We have now on hand 3 main versions, one with 3 wheels, one with 3 wheels adjusted or amended version, and the third one was 4 wheels. It's like a 4x2 light car. The minimum or the limited speed of all of those cars will not exceed 80 kilometers per hour. The electric cars, we are talking about a non-polluted transportation mean. Pollution is almost zero. It's not almost, it's zero actually. And we are also talking about a very limited budget for maintenance. We are talking about no more petrol needed, no more oil needed, because the nature of manufacturing for these cars are basically based on the battery itself. So it has nothing to do with any kind of pollution or expected pollution. Moreover, it's 75% less of maintenance cost and running cost, mainly running cost, comparing to the other ones. And this is, of course, something very competitive, I believe.
Vehicles will be produced using 45% local components. In spite of the advantages posed by use of electric vehicles, some experts fear the rickshaws might not hit the ground running.
Any means of transport with electricity is an expensive one. Imagine if the old traditional tuk-tuk cost 65,000 Egyptian pounds. Electric rickshaws will be more expensive. Poor people buy tuk-tuks. The first problem is, for example, where are the maintenance centers? If the battery is damaged, where will the owner replace it?
The manufacturers, however, say they are addressing these concerns.
We are targeting at the beginning 28 centers for maintenance and also for trainings and for charging centers to this project. We are targeting actually 1 million light car. We are also targeting a very competitive prices because still now we are still negotiating with the government whether it will be subsidized by the government or not, and they are planning to do this for serving the people or for serving the limited income people or the poor. Exclusively to you, we are targeting 35 for the 3-wheel model, the least version, then 45,000, then 55, and for the highest version, this for mini 4x2 car, it will be 80,000.
The locally assembled electric tuk-tuk is expected to hit the streets mid-2021. Yasser Hakim for CGTN, Cairo.
Quick update on the currencies. 2 in particular. The rand did weaken a little sharply towards the end of the trading day, losing about 1.5% against the American dollar in trading in the afternoon, 14.69 being the relevant number there. With respect to the naira, it continues this seesaw pattern that we keep seeing for most of February, really, up to around 408 against the American dollar in trading today, and then back down sharply to around 381. The only question really is, for how much longer can the CBN keep defending that peg? We'll find out and update you. That's it for this edition of Global Business Africa. As always, we'd like to hear your thoughts on the content you see on the program in the last hour. Many ways to get your thoughts back to us, all of them on your screens right now. I'm Ramah Nyang in the Kenyan capital, Nairobi. Thank you for your company in the last hour. The World Today is up next from Washington, D.C.